worked.
Yeah.
So that's fine. And I still see both you and me.
Yep, I do too.
Okay, so, well.
It'll be available later as a saved videos.
Yeah, there'll be a replay on this. Sometimes even on this platform, even the replays lag a little bit. So I will go ahead and post it as an unlisted webinar, or I guess it could be listed on YouTube, but I'll just let everybody know that, it is available for replay. I really appreciate everybody signing up for this conference. So we'll just go ahead and we'll get started. First of all, welcome. Thank you so very much for being here. I'm Jean Norton, and I'm here with Harold McGee.
Hey, everyone.
Hi, Harold. Long time buddy, real estate friend, investor savvy agent, and he is also a serial entrepreneur. So we sometimes find ourselves thinking alike. And he explores things, I explore things, and sometimes we find ourselves in a mutually beneficial learning situation, and this is one of them. Harold is, like I said, he's been in real estate and been an investor and does deals. He's the lead co-organizer for my weekly real estate meeting that I have here in Austin, which is, we all agree, right, Harold, that it's about the best real estate meeting we've ever attended, let alone, started.
Yeah, no, absolutely. Yeah. I mean, I get people, I'm sure you do too, coming up to us all the time talking about how much that, hey, they've been told they've got to get down to our real estate meeting. We get so many compliments for the fact that we're not like all other real estate meetups, and that we don't just push a certain subject through, that we actually are just purely networking. We're interactive. It's grown to the point to, where we have years of the same people coming, every single week, and being involved, and a lot of deals are getting done out of that real estate group. So yes, it's something that you and I can say we're very proud of.
Yeah, very proud. I mean, it's not so much that, it's not a monetary issue. It's just a sharing. But, I don't know about you, but I've had people approach me wanting to invest with some of my projects that I never would have known had it not been for that meeting. There's a lot of people that are doing really a lot of good deals. And I sort of touched on this a little bit. A lot of people, come to me and ask what should they do in real estate investing? What do they need to learn? And I say, look for a real estate meeting just like the one that I have in your town. And it really is unique, and it's of incredible value to not only just the newbies that show up or the regulars. And I think the format, it's a delight. And I think, Harold, I'd like to maybe have another webinar on what we do what we did to create this, and how it's been so beneficial. So just an idea, something to think about, because it's not that hard to start. And once you start it, people they will come, just like we did when it was like down to 4 people. We just needed to show up. But that's not what we're here to talk about today. We're here to talk about building your own bank and being able to multiply your available dollars through this very unique strategy. And I want to go over just a couple of housekeeping items on this platform. You can click on either my picture, Harold's picture, or the presentation, and it will refocus whatever you want to, what you want to have as the main focus. There is the ability to chat. There's 2 columns on the right side of the screen. There's chat, and then there's questions. Somebody's asked if it will be available later as a saved video. Absolutely. You're welcome to watch it as many times as you want. It will always be on this platform. Because you registered here, you are in my community, my real estate community, and you'll be able to watch these webinars, recorded webinars, anytime you want. So, if you've got questions, please click on the question, type your question in there. And if you just want to chat, even amongst each other or whatever. Let's see, somebody says, I've joined and have video, but can't hear. Well, I hope that's resolved.
And then it looks like Fred said volume control on your pick. Oh, okay. Looks like, okay. They're getting it figured out, it looks like.
They're getting it figured out. Okay. Yeah, that sounds good. I mean, because we're kind of busy doing this. But, Harold had told me about this infinite banking term. And, he'd said, I don't know, how long have you been doing this, Harold? About a year or so?
Yeah, a little over a year. Started working on it. Actually, I started working on it a while ago, but really implementing it as a part of what I'm doing about a year now. And I mean, so much to the point that, Gene, you've known me. I started building a property management company in, was it February of 2007 is when I took on my first property. And I sold it last year to the agent, now broker, who had been running it with me for the previous 3.5 years. So, I mean, this is something that I had really been looking and delving into and trying to learn as much as possible and really take it to the point to where, okay, this is a focus that I'm going to put onto my real estate advising and consulting business.
Well, and I think it's incredible. I'm really delighted to be able to share this with the people that have registered. I really think it's a great opportunity to be able to leverage this tool to use the same dollars, and we're going to get into that in a little bit on exactly how this works. And so, Harold, do you need me to click through these screens, or is that something you?
No, I think I've got it. I see the buttons here. I know this is my first time using this this application, but if I have a problem, I will let you know.
Okay. Well, yeah, this is a new platform for me, so everybody, please be forgiving with any technical issues that might have come up. So, but I think we can go ahead and get started. So, Harold, it's all yours.
All right. Thank you, Gene. Well, for those that had come in late and don't know me, my name is Harold McGee. I'm a real estate broker here in Austin, and but before getting my real estate license in the mid-2000s, I actually started out of college into financial services and then kind of worked my way into some commercial lending, asset lending, leasing, and mortgages, some commercial things. And so I had really built up my experience around financial knowledge and dealing with numbers and credits and balance sheets and profit and loss statements. And so I'm well-rounded on the financial side. And I had come into this theory that's called infinite banking. And so much to the point that a little over a year ago, once I had decided to sell my management company, is I went and actually sought out and got the certification for this infinite banking. And over the last year, just started slowly and gently kind of putting it out there into local contacts and best contacts to, hey, this is something that I'm working on. It's something I want you to take a look at. And you being one of those people, Gene. Mm-hmm. And then I have since partnered up with a couple here in Austin, Keith and Terry Hoffman, who come out of the financial services industry with a breadth of knowledge and deep value that we can now lay out as a platform and start building our business model off of that. And that's where we're at today. So I'll just go ahead and jump right into it. Now, the website that I have used to kind of start this off is myrealestatebank.com. And I did real estate bank, obviously, because I'm a real estate broker, and or a lot of my knowledge and contacts come out of the real estate investment world. So I wanted to apply this directly to real estate investing. However, this theory can apply to all kinds of things in life. It's just shifting your liquid assets into this product and service so that you can capture all of it for all of your life, including existing uses and for your retirement needs as well. But you know, what our presentation, and Gene, what you and I kind of work in, is the real estate investment realm. So that's kind of what we have.
And actually, I did invite people on my personal Facebook group too, because I understood that this investment strategy can work beyond just real estate. But most of my friends are real estate. But yeah, you can use this strategy for any of your investments. So I welcome anybody that is here not real estate related. So don't feel like you're in the wrong place.
Yeah, exactly. So, okay, so I'll just go ahead and get right into it. So build your own bank. And in this case, we talk about building your own real estate bank to help you build that real estate empire. That didn't go. There we go.
Okay.
I hit the next.
Okay, there. I see
it. And to introduce our team, like I said, my name is Harold McGee. I'm a real estate investor, a real estate broker, an internet banking practitioner, and I have predominantly worked with real estate investors and their building their portfolios as a buy and hold investor, and thus it kind of built me into helping them grow or helping myself grow a 120 plus unit property management company, which I have since sold. Also, my business partner in this endeavor is Terry Hoffman, who is a chartered life underwriter. She's sitting right next to me here, by the way, kind of listening through the front side of it, and she has worked in. I'm sorry, that's small. Like I said, a CLU, a patent holder for systems and methods of determination of long-term care benefits. So that's pretty interesting. And then her husband is Keith Hoffman, who's a real estate investor, financial education instructor, and a disability specialist, licensed insurance agent, and a prostate cancer survivor, and a world champion swimmer.
pretty accomplished people.
That's right.
Yeah, you can't say that these guys are underachievers, not at all.
That's right. All right, the agenda today is why real estate investing, becoming your own bank, the infinite banking concept. We'll go over a case study, and then what would be the next steps to get started, and then we can finish it up with some Q&A. And Gene, I think you'll be looking at any kind of the question log and chat log. Feel free to interrupt me as we go. I saw.
Yeah, and I put note in the chat log, the myrealestatebank.com. Okay. The benefits of real estate investing. First of all, you get appreciation when you own real estate. You have an equity buildup, which is obviously the difference between any of your underlying liens on it and the value of the property that's going up. Positive cash flow, specifically when you are renting it, and or I could be tied to if you're receiving interest income of a note. Favorable tax consequences. The biggest one that we're most familiar with, it would be like your write-off of its depreciation of its asset. So you get appreciation, but then appreciation at the same time. And then obviously it's an inflation hedge. So those are all some of the kind of the higher aspects of real estate investing. But then we have additional opportunities when using this method. We believe that you can be in more control of your own
money. We believe some of your money can make more money than it does today. And there are other alternative strategies that you can leverage. What is infinite banking? Infinite banking is a specifically engineered whole life insurance contract. Whole life insurance or permanent insurance offers tax-free growth. It also offers cash value buildup. It's tax-free participating dividends from the premium that is compounding annually. You can then borrow from the policy at any time with no questions asked, no credit qualifications. You don't even have to pay it back. But I mean, you should, or at least pay the interest on the outstanding balance, because you don't want the interest to start compounding against your dividend. So the whole goal is to pay a flat interest, like as opposed to a amortized loan. This is only interest only, like a line of credit.
Got it.
Right?
Can I ask a question?
Yeah, absolutely.
Yeah, Harold, all my adult life, pretty much most of my adult life, especially early on, I mean, when somebody mentioned life insurance or insurance, I mean, it was like, and we talked about this, it's like, I feel like every bit of intelligence left my body. And, it just seems to be, it's a complicated financial vehicle, and it does so much more than what its term is, what it's called, life insurance.
Mm-hmm.
But really, it's another investment vehicle. So tell me if I'm wrong. It's another investment vehicle that you can use and benefit from. And if you happen to die, somebody will get some amount of money that's stated on the life insurance. Is that correct?
Well, it's partially correct. And let me make some clarification.
Okay.
Life insurance, and in this case, specifically permanent life insurance that has cash value attached to it, is not an investment. It is another asset class, but it's not an investment because of the contractual guarantees of it. It then takes out the investment part of it. And investment is going to be based upon a potential loss of the equity. For instance, buying real estate is an investment because there could potentially be a loss to it, right? But with a permanent insurance policy, and again, specifically, we only work with participating whole life policies or participating dividend whole life policies issued from a mutual insurance company. You have contractual guarantees that are tied to that insurance company. Well, all these insurance companies that we work with have been around since the mid-1800s. And though paying a dividend is not contractually guaranteed, they have been paying dividends since the 1800s, including through the Great Depression.
Wow.
So you have some contractual guarantees. So as long as you make that premium payment, that contract is guaranteed. Therefore, it's not an investment. It's just an asset class.
Okay.
So that is, from that aspect, it is another asset class that you then put on your balance sheet. Yes. And it's something that you use, and you access the cash in this policy, not by taking it out of the policy, but by borrowing against it. So you are borrowing proceeds from the insurance company's general fund. You're not borrowing it from your policy. Your policy just acts as a lien holder. And the reason why that's important is because your policy, the funds in your policy, start going into the compound. And they start going to a compounding dividend. And these dividends that are paid out are substantially higher than any type of savings or money market account. Anything that's very, very liquid, this is going to be one of your best returns on the cash in and of itself. And again, it could be anywhere from 5 and 6% are standard, but we have one particular insurance company that we work through that we can offer anywhere from a guaranteed of 4% if it's paid out up to 12.5%. So
okay, well, I'm interested in seeing how that works.
And we would do that obviously once we get into our further discussions.
Okay.
All right. Oh, it started over on me.
Uh-oh.
Okay, so there we go. So with this, you get the benefit of both worlds. You get all the appreciation of real estate and the appreciation of infinite banking. Obviously, the appreciation in real estate is the value of that asset is going up at the same time the value of your policy is going up. So as your dividends start to grow, we use what's called paid up additions. Those dividends will purchase additional insurance and drop cash back down into your policy. So therefore you're getting appreciation. Again, you've only have input of $1. So you put the $1 into your policy first, and then you're able to borrow out against that for the real estate. You have equity build up, obviously, in your real estate, and you have equity build up into your policy. You have cash flow in the form of, normally it would be cash flow from rental, let's just say rental income off of buying home. And you also have the cash flow that's growing in the dividend compound on the insurance side. You have favorable tax consequences for real estate. Again, we mentioned about all the write-offs that you get with it. Most notably would be like your appreciation. In infinite banking, you have the favorable tax status in that it is tax-free. All of its growth is tax-free as long as you don't pull out the money above and beyond what you have contributed. So whenever you take a loan from it, that's not a distribution. That's simply a loan. So that the tax status of the loan is tax-free. You're not taxed on that money that you pull as the loan. And the loan is just held against the death benefit for if you do pass away, then those loans will be paid off before the rest of the money goes to your beneficiaries.
Okay, so.
And that's going to go to them tax-free. Yeah.
Okay.
So the buildup is tax-free, and then when it passes through the estate to the beneficiary, it's tax-free.
So if I have $10,000 and I wanted to move, and if I'm getting ahead of myself, just stop me. But let's just say I have $10,000, what would I do to multiply or to leverage that for more investing funds?
Investing funds, as in you also want access to that $10,000 for a real estate deal.
Right. Let's just say I've got $10,000. I could maybe put it on use it as a down payment for a real estate deal, or I could invest or create this asset class create this asset of this whole life insurance policy and borrow against that and earn. I mean, I guess I'm getting a little fuzzy here. So how does that work?
So building an infinite banking policy or policies, plural, that we teach investors to do, it's a long-term play, right? It's long-term, like building a buy and hold portfolio is a long time, right? So this is not really a one-time contribution kind of deal to make this work for you effectively. Building an infinite banking policy system it's a multi-year setup, right? So you don't make one $10,000 contribution and then you're done, right? So these are insurance policies. So you do have to get committed to it and stay committed to it. Now we have several different ways that we can structure it so that you can make some of the commitments shorter or less than others, but you have to be willing to put into it multiple years for it to effectively work and for its dividend to start compounding sooner rather than later. So if we sit down and talk about this, we're not looking at just 1 year. We're looking at many years. So that you have to build these up, and you have to start getting it funded with it, and so that you have the cash available to start borrowing against. Now, if you only had $10,000 to start it, we'd say, well, that's fine. How much are you going to have in years 2, 3, 4, 5, 6, right? And so we have to look at that kind of long-term horizon, because if all you were putting in was $10,000 right now, I mean, we could make that happen. We'd build the policy around it, but you're only going to have access to probably in the first year, maybe $6,000 to $7,000 of that $10,000, just by the way that insurance policies are structured. They're much like, I would like to compare them to, say, a amortized loan. If you look at like a 30-year amortized mortgage, in the first 5 years, it's substantially all interest that you're paying with very little principal pay down, which is your equity of that home, or part of your equity makeup of the home. Well, it's the same in an infant banking policy. A lot of the insurance costs are kind of front loaded, because if you think about it, once you write that first check to an insurance company, they have to honor that policy. So if something happened to you, let's say 2 months after getting this insurance policy, you put in maybe $10,000, but that was based upon a $500,000 death benefit. They have to honor that $50,000 for only receiving $10,000. So the contract and the commitment goes both ways. It's not just one. So, when we build these, now we structure them in a way that we get a lot of cash value in there now, but the fact still remains that no matter how we do it, there's still going to be a certain amount of insurance costs that are kind of front loaded into these. That's why they have to take a longer term approach when doing this, in order to complement your real estate portfolio.
Okay, so when my husband and I got married years and years ago, we took out a whole life insurance policy on him. I don't even know why we're still making payments on it, because he's, we're old now. So, I don't get it. I don't understand it. Again, once you mention insurance,
y'all still have it, right?
My eyes glaze over.
But y'all still have this whole life policy? Okay, because you've been making payments, so it's contractually guaranteed, right? Now, I don't know anything about that policy. However, because of its contractual guarantees, as long as you've made that payment, you still have it. And y'all have been using it specifically as a death benefit, which is how permanent insurance has been sold for over so many years. And I'm not trying to diminish the value of a death benefit, because that's going to be great for your sons, right? But how we structure these is we have cash.
For me, he's older.
Sorry, that's right. Okay. That's right. I just jumped right over it and just bypassed you, Jean.
It's okay.
But we structure these to get cash value in now, and then show you how to borrow and or pay it back, so that you keep your line of credit, essentially, we'll call it a line of credit, growing, and growing. So it's always accessible to you through the loan provisions of the policy. And the kind of another part that that we're advocates on in the infinite banking world is getting out of this third party Federal Reserve banking, fractional reserve banking system that we have, and you controlling all of your lending and money spend and velocity of money in your own realm, if you will. So, that's what we're spreading the word of, and working with, and again, my case, investors specifically, and showing them how to recapture all of the interest that they have been spending into our fractional reserve banking system, and being able to build your own lending facilities inside of your own cash value life insurance.
Okay, so how do I do it?
Well, first of all, connect with myself, and then I'll bring Terry into the fold, and then we'll get with you and anybody that wants to learn and sit down and probably go into a little more a deeper dive into the inner workings of this as opposed to what I'm presenting now, and then kind of go over some of the theories of how to use it with regards to what they are doing specifically. And the benefit is that I'm a real estate broker myself. I'm also a very experienced real estate investor. I'm very adept at dealing with subject twos, owner finance, wraps, wholesales, double closes, buy and holds, fix and flip, all of that. So when we sit down and talk, I'll know everything about your business model, even notes. I hold notes in my 401k. I really don't have much of the tax lien experience like you do, but again, it will be knowledge that I already know about the real estate investing business. So I'll be able to adapt what you're doing right now and what you're looking to do to this.
So I can borrow money from the life insurance policy to purchase a note.
Correct.
Okay, and then I benefit from the, even though I'm borrowing and then I have to pay interest on the life insurance.
No, technically you don't, but you want to.
Okay, and then I get to clear the difference.
Correct. And that what I would do with that difference? I'd put it back into your policy, because that's going to keep growing and growing. It helps accelerate the growth of your compounding dividend. So when it's compounding, and then you kind of add a little more snow to the snowball as it's in mid rotation down the hill, it's getting bigger and bigger and bigger, which just opens up your line of credit to borrow against. So,
okay, I see.
So to effectively do it, I would suggest that you pay back at least the minimum interest of the outstanding loans. And then any difference goes into what we call your paid up additions of your life insurance. And that's essentially, paid up additions go above and beyond the cost of insurance. So there's very little cost of insurance associated with that. So almost all of it goes into your cash value. And then that's growing the policy, which then in turn is growing your dividend.
Okay. There's a question here. Is the line of credit reported to any of the 3 credit reporting agencies?
No. It's not.
So that's good.
Yes. Yeah. I guess it's good from, it's not going against your DTI on your credit report, but if you're putting it on your balance sheet that it is, especially if you're writing off that credit, like if the loan will come to you personally, whoever the account holder is, right? So it'd be up to you if you then make a deal with an LLC that you own, that it's going to borrow from you, and then you can have that, write that off if that's how you and your accountant do your tax filings. So it's not reported on credit, no. And it's essentially fully secured from the cash value of the life insurance.
The cash value of the life insurance. And the cash value is really the amount I've personally invested into that life insurance.
Yes, yes.
Okay. So if over the years I've invested, I made my payments and it's now got a cash value of some amount, let's just say, over the years that we've got a $20,000, $25,000 cash value. And I don't know what our cash value is, on my husband's policy, but I guess I could find out and then find out how I could borrow against that cash value. Right. Got it. Okay.
Here's a couple of notes that we do have, and I see another question in there from Andy. That is a big thing that I do want to address. There's a couple things that we do are very specific to building this. First of all, we reduce the cost of insurance significantly with the way that we structure these, so that if you dump in, let's say $10,000 or $20,000, that 60 to 70% of that is going to be going into your cash value now, which you then have the ability to borrow against, say, next week, right? So it's that quick of a turnaround that you can have access in a loan. Second, I don't know where Bill's insurance policy is issued from, but we only work with mutual companies. Mutual insurance companies are like credit unions. They're owned by the policyholders, meaning there's no outside investors. If there's no outside investors, you don't have to pay outside investors a return. So all the return from a mutual insurance company goes into your dividends. That's key, because the return and the dividends are much, much higher than they are just sitting in a bank somewhere. I mean, we're talking on average 5 to 6%. Depending on the company. And again, we have one company that could be anywhere from 4 to 12.5%. So that's another thing, is dealing through a mutual company. And all these mutual companies have been around since the mid 1800s. So they're very stable and secure.
Okay. Well, that's good to know. I didn't realize that difference.
Yeah.
I suspect mine is some.
Yeah, so it may be that and if you've only been making the minimum payments for just the death benefit, that's fine, but you're not going to have a whole lot of cash value in there. But if it's issued through a stock company, well, they may not pay hardly any kind of dividend. So you're basically just paying to keep it afloat and keep it alive as a death benefit. But that's not exactly the way that we do it in the infinite banking.
Okay. And so then Andy's question about the IRA contributions, can you address that?
Yes, Andy. We have been looking, because a lot of our real estate investors, that they have the majority of their assets are in old 401ks that they've turned into IRAs. They may turn them into self-directing. I'm very comfortable with using self-directing. I self-direct myself. I have a 401k that a solo K, as we call it, myself. IRAs and 401ks cannot own the life insurance itself. That's one of the few restrictions. However, if you've already reached the 59 and a half and later, there's certain things that we can do with the IRA to start having your distributions funded. Yes, there's one way we can do that. Also, if you are in your early to mid 50s, there's something that is called 72T, correct? Yeah, 72T, where they can have the contribution start out early. Now, there's some details. I don't want to make it. It's not just that simple. There are details and caveats to that.
We want to keep it simple here.
And then for those that are younger, it is possible we could roll it into a solo K. We have found a solo K provider, so a 401k. And depending on the size of that solo K or 401k, you're allowed to borrow up to half of that value, up to $50,000. So we could set it up in that way that you could take a loan from it to then start funding the policy, which is something that I would probably do myself, and what I will do, because all the loan interest that you pay back to your 401k is all yours. So you're in the same spot. You are building up that plus your infinite banking policy.
We talked briefly about using somehow leveraging your children for this benefit.
Absolutely.
For example, I've got 2 boys that are in their early 20s. Their risk level of dying, well, depends on whether it's weekend or not, but how would that work? How would it work for me to have an insurance policy on them and to be able to borrow from?
The great thing about insurance policies is that you don't have to be the insured to be the owner. They can be 2 different people. And it's the owner who controls the policy, not the insured, right? So the very first policy I wrote up, I was still working on a couple things I needed to get qualified for underwriting for my own policy. So what I did is I went ahead and got a smaller policy and used my 18-year-old son as the insured, but it's my policy. I own it. I contribute to it. I control everything about it. And so I can turn it over to him whenever I want. I don't know when that will be, but I know I control all of it. And then just recently, once I was able to deal with a few things, I got my own policy. So yeah, it's great for especially older investors that may have children themselves or even grandchildren, that they can insure and that they are still the owner and control all of the policy and the money inside of it.
Well, I might do that, so I may have to set up an appointment.
we are ready for you, Gene.
Unfortunately, all of my cash is currently, I told you the other day, I'm a good real estate investor. I keep my cash balance low. That means it's deployed and working for me in other areas. But I need to plan that in my future.
To the choir. Actually, I just had a event on Friday, which I got liquid on something. I'm going to write a check to the insurance company. I'm putting it into my paid up additions, because again, that money sitting there waiting for me to use it for a loan is getting a much better return than it is sitting in the bank. So I'm not losing out on for while it's just sitting there, and then and then I'm ready for it to be deployed when I find that next deal.
Right. So you're going to go. So this is a good way then to earn possibly, like you said, 6% interest in a safe, secure vehicle. Right. And you're not really earning that interest. It's compounding into the policy.
Yes, that's right. It's compounded in the policy. It won't be paid to you directly. You can. That's one of the elections you can do, by the way, but that's not something that we promote. Not to build this.
Okay. Yeah, it makes more sense to have it compound to the policies, because that will increase your borrowing power when you're ready to borrow. Now, what interest rate do you have to pay for that when you're borrowing?
Again, all carriers have different types of loans that they offer. We see generally anywhere from 5 to 6%. Some of them you can offer what's called into a variable loan rate, which is tied to some sort of index with some sort of margin. So I mean, it could be, those variable loans could be 4.5% now, but they're always going to be tied to that index. So if rates start going up in the market, that variable loan rate will go up. And for us, we will kind of take the longer term. So we'll usually go to a fixed for a certain amount of time. And then after a certain amount of years, that fix will actually go down irregardless of what the market is on the rates. So we know in retirement, we can already plan based upon those numbers. And that can go all the way down to 4%, irregardless of where the index and margin is on the variable rate side.
Okay, let's see. I think we have another question here. Let's see, just the video question. Is there a health test to pass in order to get the insurance?
Is there a health test? Yes, for the most part, because we are dealing with permanent insurance from whole life carriers. Most of the non-medical stuff that you see in the insurance world is going to be on the term side. You don't see it a whole lot on the permanent insurance side, whether it's universal life or whole life. But we are seeing more and more carriers that will bring out the non-med insurance policies on permanent insurance. It just really depends. We would have to look around. And there's a couple other companies that we can go to that may have relaxed underwriting for a small whole life policy, but that, we can look into that. But for the most part, we would expect to at least get your blood drawn, blood pressure, taken, and a couple things like that.
So if you are going to use your children for this investing vehicle, your chances are pretty good, that they're going to be at a healthier level than you
That's
or me.
That's correct. That's why I had to wait.
Okay. Yeah. So, and it's really for their benefit.
But I can
too.
tell you, if you're on any kind of medicine, maybe if it's just one medicine, that is not a big issue anymore. It used to be, but now it no longer is. And the insurance companies actually will still give you a very favorable rating, even if you are on one or two medicines, because at least they see you're taking care of it. So that really it no longer works against you.
That's good to know. Yeah. Okay. So I, again, explain it to me like I'm 5. I've got $50,000.
There you go.
And I'm going to sign up one of my kids or both of them with an insurance policy, and I'm going to put money in that insurance policy, and that is the cash value, is the amount I put in, because there's no dividends at this point.
That's correct. But let's say you split that 25 and 25, you wouldn't have access to 25 and 25 immediately. Remember, I talked about that the cost of insurance and a permanent insurance is front loaded. So you actually would have access, the way we structured these policies, you'd have access to 60 to 70% of it right now. And the goal is to, within about 5 to 7 years, have access to all of what you put into it.
Because the compounding.
Exactly. We have jump-started the dividends and the compounding of the dividends to really kind of get it going down the road, so that it's getting caught up for the cash value compared to how much money you put into it, so that you can kind of feel that 30% loss to the insurance over those first couple of years.
Okay. Okay. Let's see. Does it have to stay in the policy a certain amount of time? Yeah, Agnes asked if it has to stay in there for a certain amount of time. We just sort of talked about it. It doesn't have to be that long. It's just affects how much you can borrow.
Exactly. So that's Agnes's question. Yeah, I mean, if let's say you put in the $20,000, depending on, again, how we structured the policy, how big we made it, what the actual minimum insurance premium is underneath it. Once that's established and it's fully funded, you'd have access to that money, within probably about a week. Once they get all policies set up on the system and know what the cash value is, then you can request a loan.
Okay. A week. It's
No.
not bad. Okay, so we've got another one from Andy. Do you need to be consistent with the amount you originally fund the policy with year after year? So if you put in $10,000 this year, do you have to put in another 10 next year?
That's a great question, Andy. You do have to be consistent, but we build these with a lower cost of insurance associated with it, right? So you do have to have a commitment to it. It could be anywhere from 7 years to 50-something years. And you'll know what that is before you commit to it. But most of them are not $10,000 a year. I mean, again, depending on different factors, age, the size of the policy and stuff like that, it could be a couple $1,000s a year that you have to stay committed to, but you have the ability to keep putting in that $10,000 or $15,000 or $20,000 a year, which is what you want to do. This is literally a great way to store your cash.
Well, it sounds like a great way to store your cash, and also, like you said, use it as a line of credit for when you want to invest in real estate, because then you have both vehicles working for you
at
the same time. So you're still getting the dividends, even though you borrow. You've got a cash value, let's say of $20,000, you borrow $10,000, you're still getting your dividends based on the $20,000 cash value, because you're paying interest back to the loan, which is minimal compared to hard money or other, creative finance.
Yeah, it's much less expensive than hard money, but it's also fully secured by the cash value in your policy. As a matter of fact, on these slides, I have a little case scenario if you want to run through that real quick.
Yeah,
All right, let's see if I can.
Yeah, I think it started over on us again.
Okay.
Yeah.
Okay, here we go. Now on my screen, this looks pretty small to me, and
yeah.
So yesterday when we were doing this, I made this larger, but my video may actually go to my profile picture. So I'm gonna go ahead and I'm going to expand this for me to look at, but just beware it may go to my profile picture.
Yeah, I haven't seen that happen this whole time, but I do see, you can click on any one of those images and to enlarge it. If you want to see all of Harold, just click on Harold.
Well, I wasn't able to expand it, so you're going to see me looking really close here into the mirror and squinting so I can see these numbers.
Yeah, it is hard to see, but
let's go ahead and take a look at this, and we're going to go with some assumptions here, right? This is not a first week policy. This is going to be an established policy of several years that has $100,000 of cash value sitting into it, right? So we need to make that assumption. And let's say you found a house that you want to buy, a buying home, and that you can get it for $100,000, and you know that the rent is $1,000 a month, right? And you're going to self-manage. And again, there's some other assumptions in here that we have not accounted for, like expenses such as insurance and taxes and things like that. So we're just kind of running through all the gross numbers, not taking account any of the net numbers. We need to look at that.
Trying to keep it simple.
Just keeping it very simple. So if you take a look at this, if you buy a house with cash and you have, I believe this is a 3% appreciation rate per year. So for 30 years, right? This time is going over 30 years with a 3% appreciation rate, and you're getting $1,000 a month in cash flow rent. Your appreciation at the end of 30 years is $242,700. Is that $26? Oh, thank you, Terry. $242,726 in appreciation. You will also have amassed $360,000 of rental income. So that's a total accumulation of $502,000. I'm just going to kind of round. And you take into account your $100,000 purchase price. And so your total that you have gained is $402,726, right? Now, if you had taken out a loan from your insurance policy and bought that same property, you would still get all the same benefits of the actual house. So those numbers don't change, right? But now if you take a look at your banking policy, you would still, you'd still have the same appreciation. You would then, your cash flow would be reduced to $167,547. Now, taking into account you were actually paying the interest from your cash flow. That's why your cash flow is reduced from 360 down to 167, right? So you have a total purchase price, a total gain of $410,000, and then you subtract out the $100,000 you had, which gives you a gain of $432,000. But at the very same time, you've actually had growth inside of your policy of another $387,000, almost $388,000, for a total growth of $1.2 million between the two accounts working together off of that very same dollar.
I feel like I had a V8 moment. Dang, I could have had a V8.
So you had both the the real estate asset working, and you had the cash value inside of an insurance policy working. And mind you, the cash value and growth inside of the insurance policy grew tax-free, and it was asset protected. So it's got asset protection, just say like your IRA does or 401k. It's got all those asset protection points to it.
So, so we've got that potential profit, we've got the tax-free income. It reduces our cash flow because we are treating it as a loan and we have interest we have
Correct.
to pay. So all of this is actually building more value in the cash value of the life insurance. When do I get to go out and buy that fancy new car?
Well, and so your cash value continued to grow, even though you're paying interest, you're putting the difference into the cash value of your life insurance. So on top of that, with the dividends, because your dividends are still growing, even though you have money outstanding, you don't stop your dividend growth or the compounding of it just because you have a loan outstanding, because you never pulled the money out of your account. It always stayed in place. So that growth, 30 years later, a compounding of a dividend is substantial. You can go out onto any kind of website, financial website, application, and just take a look at a compounding chart. I use when I'm a vendor at places, I have printed out on a sheet showing a penny that doubles every single day. And by day 31, 1 penny is now $11 million. And it's all in black and white right there. You cannot dispute it, right? Now, that's a very extreme case of compounding, but what I'm trying to show, it's compounding. So it's really the magic of that happens in the last week of the month for that compounding to take effect, right? Going from 1 penny to 2 pennies, that's not significant. Even at day 21, it's only at $10,000. So in those last 10 days, it jumps from 10,000 to over $11 million. So again, that's how compounding works. So, and that goes back to using, having our children be the insured. The back end of these are significant. When I first started talking to my son about it, I had him download a financial calculator on his iPhone. And we sat there and did $100 a month from the time when he was 18 to the time of 65. And then we did it and we looked at mine, $100 a month from the time I'm 47 to the time I'm 65. And his value was significantly higher than mine, obviously, because of the compounding effect.
Right. So at the end of, let's say, okay, you're done. You've built all your wealth. It's all in this insurance policy. Can you withdraw that money for your personal use?
Yes and no, and it depends. That's a typical lawyer answer, right? It depends on how it's structured, what you do. And we would have to just tackle it at that time or go over the different scenarios of theoretical timeframes of when you do it. You can. There might be some tax consequences to it, or you might be able to do it without tax consequences. It depends on how it's structured and what's done at that time.
Okay, we got a couple of questions. Agnes asked, can you insure a child that is not your child?
Yes, as long as you can prove that you have an insurable interest in them.
Okay, and the next question, Neil asked, when the insured dies, do they get the 1.2 million or the face value of the insurance? So what happens, what happens if they, if they die? What do you get? Do you get
when there's a death, you get the death benefit minus any outstanding loans.
What if the cash value becomes greater than the death benefit?
Well, the insurance company will do things that won't allow that. They won't lend out any more money to you, and will take into some overloan protection methods. So they essentially would not allow to do that.
So they will not allow, so you start out with a $500,000 policy, you can't have more than a $500,000 of cash value.
Well, are you talking about death benefit or cash value? There's two different things.
Well, yeah, we're trying to compare and contrast the death benefit and cash value, and which we're talking two different values here. Which one supersedes the other?
Cash value is what's used for loans, not
right.
the death benefit.
Right. So the cash value.
If you had a $500,000 death benefit, you may only have $10,000 or $20,000 of cash value, depending on how aged that policy is and how you have funded previously. So your loans are only going to be based upon that.
Is it possible that the cash value could be greater than the death benefit?
No, never. Only in your, I think based upon, and now is it 121 is based, they'll always match each other. Because if you look at it, if it ever is that amount, if your death benefit and your cash value equal the same thing, you will have never put in that much money yourself personally for it to equate to that. So it's you're using your cash value, your cash, and the dividends to buy additional insurance. So you get growth of the cash value, but only because the death benefit is also growing at the same time. And the cash value does have a higher growth compared to its actual death benefit, because they do catch up to each other and age 100 plus. So, it's really, the number is the death benefit, because the cash value will eventually catch up to it. That's only because of the compounding effect of the dividend, not because of your contributions will it ever be like that.
Okay. All right. I think I'm starting to understand. And it makes a lot of sense, and I would want to move forward with something like this. And if anybody else wants to move forward and has personalized questions for Harold or for me, there's a little button up top to book, says book time with Gene Norton, but you'll really be booking time with Harold, or just a way to get in contact with me. And of course, Harold's website is myrealestatebank.com.
Right. myrealestatebank.com.
Yeah. And, this is one of those things that there's so many, what if scenarios that, I don't think we can cover it all just in an hour.
No. That's and there's a lot of little nuances, little details that people want to know. And obviously when we sit down one-on-one with them to cover all of that, they'll never go into this not knowing what it is and how it works.
Okay. Well, that sounds good. And Harold, should I put your phone number up here?
My phone's number all over the web, all over my profiles.
I know it. 6470. I almost have it memorized.
512-626-6470.
Yeah, yours is probably one of the few that I actually can remember, just because I see it everywhere.
That's right. Yeah, there it is. Okay.
Yeah. So, if you've got any more questions, just feel free to contact Harold. He's, let's get your email here too. It's HMcGee, right? HMcGee at captexproperties.com. And so you get a hold of Harold with that. Anybody wants to reach out to me, they're more than welcome to. I've actively recruiting for people who feel like they need a little bit more help or need somebody on their side when it comes to real estate investing. So I'd love for you to consider me to be your advocate as you go forward with real estate investing. If there's any other questions, I want to encourage you to ask them now, because this is quite a unique way to build your wealth over the long term. And if you've got any questions, did you have anything else you wanted to cover on this, Harold?
Yes, real quick.
Okay.
On the just kind of wrap up the presentation on becoming your own bank. You can be more in control of your money. You can make more time. You can make more money with your money, right? So, and provide a replacement income for you and your family. Like, again, it didn't have to just be real estate, but it's for a lot of asset purchases or big events, big life events, weddings, college, substantial vacations, substantial purchases.
Now you're talking my language.
There you go.
Vacations.
Exactly. And then another thing that Terry and I work with is what's called the Living Balance Sheet. And it's an online web portal that each investor client gets on their own. They can then sync in and aggregate with all of their financial accounts and balances, and we kind of bring it all into one spot. And then it's really an interactive, customized private website that they get for themselves. It's called thelivingBalanceSheet.com.
All right, I'll put that in here. The Living
You got it.
Balance. Okay. Yeah, I'll take a look at that too.
Yeah, and we that's kind of what we start to sit down with the clients and help them get that set up, get that going, and kind of use it as a basis for going into our plans and building these. Let's see what else is there. Okay, yeah, there's a little more detail on it. Let's see. Okay, yeah, and this is kind of a screenshot here of assets and liabilities and insurance coverage and cash flow. So there you go.
Well, Living Balance Sheet. Okay, I'm going to take a look at that as well. So again, if there's any questions, I think I've given you all of Harold's information, how to get a hold of Harold. Of course, you guys know I'm available almost all the time. I'm busy on Facebook, Gene Norton's Real Estate Contacts. And, if you want to just book some time with me, you can message me on this platform or just reach out to me. I'm Gene at GeneNorton.com. And Harold, thank you so much for explaining this to me. Yeah, I still have questions. I mean, but I don't think I've formulated what the question is yet.
Well, Gene, you know how to get a hold of me.
Yeah, I know. Okay, we got to thank you. I appreciate it, everyone. You'll get notifications of the replay. And, again, thank you very much for being here. And let me know if anybody has any ideas for topics for these kinds of meetings, anything else you want to know, please, I'm open to ideas and, happy to schedule more of these in the future. So. All
right. Thank you, Gene.
I think that's it then.
Thanks.
Okay. Thank you very much. Bye-bye.